Hi, and welcome to FFCON 2021. Thank you for joining me today. I'm Georgia Quinn. I'm the General Counsel of Anchorage Digital. We're a digital asset platform, and we're also the first federally chartered digital asset bank. So I'm here today to tell you a little story about how this all came to be. As you may have heard, in January of this year, the Office of the Comptroller of the Currency gave us a federal banking charter to custody digital assets. We can also do a few other services like settlement. We can do governance and staking services as well. So you may be wondering, how did we get here? How did this all happen? Well, it wasn't always this way. We were just a happy-go-lucky South Dakota state chartered trust operating under the South Dakota Division of Banking. We had a wonderful relationship with our regulators there, and one of the things that we really enjoyed, and I think really set us up well for our eventual federal charter, was an understanding with our regulators and their appreciation and openness to the technology of cryptocurrency and blockchain. And, it's relatively rare, I think, in a regulator to be so open, but South Dakota had a long history of banking and trust regulation, and they, were ready at this point to embrace the future, frankly. Some of the things that were different about what we did versus a traditional trust or bank company that are specific to crypto assets are biometric authentication and proof of exclusive control. So in order to access assets using Anchorage's custody solution, we biometrically authenticate the users using voice, speech, and fingerprint recognition. We also are able to prove exclusive control of the assets because we bifurcate all client assets on-chain in their own individual vaults. This also helps us with proof of existence because our clients are able to see their assets both in their Anchorage application, but also on-chain, through an external block explorer or other mechanism independently. Their auditors can also prove the existence in both places. We obviously offer extensive blockchain monitoring, both prior to the assets being deposited and once they're withdrawn. So this is something that is unique to the blockchain space, where we don't have the typical FedRails and wire and ACH sort of implementation, and we are utilizing an actual blockchain. And also, really importantly, we utilize the hardware security modules. So at Anchorage, we feel that the safest way to secure the cryptographic material and the key is using an air-gapped hardware security module rather than just sharding it and distributing it amongst multiple parties. And by using this technology, we limit the potential surface area and human error. So all of these things were understood and incorporated by South Dakota and built in basically to our regulatory structure operating as a trust. That set us up really nicely. But why did we need to be a bank then if we had all these great things going for us? Unfortunately, operating on a state regulated level really constrained our growth, and it inhibited us in three important ways. So first and foremost, operating in one state under their regime does not necessarily mean you can operate in another state. Every time you want to move into another state or service clients in that state, you have to conduct a regulatory analysis. Do I need to get a license in this state? Do I get reciprocity based on the license I already hold in South Dakota? What is the regulatory regime here? What is required by this license? If I apply for this license, what do I have to maintain over the course of my operation here? Does that conflict with what I have to do in another state? And so this kind of multi-state analysis just became unwieldy. And when you think about something like the internet or blockchain, cryptocurrency, it does not stop at state borders. So to think you can put these artificial barriers on this type of technology just really was a little absurd. And so we needed a federal regulatory overlay. Also, it was important for us and for our clients, frankly, that we were what's deemed a qualified custodian by the SEC. Now, operating as a state chartered trust, we felt that we were, but it requires an analysis because the way the rules are drafted and the definition is construed, you must provide, state chartered trust activities that are fiduciary in nature, that are like those that would be provided by a bank. I mean, it's this whole long analysis that you have to do, and it can be somewhat subjective. So now that we're a federally chartered bank, we meet the black letter definition hands down. We are a federal bank. We are members of the Federal Reserve. Like, these are statutory requirements that we meet, and we don't have to go and have this analysis and discussion with our clients or potential clients. And then the final thing that really was really a driving factor is the fact that as a state regulated bank, you have a different set of regulations than other nationally regulated banks. So if you want to provide services to those national banks, you have to, again, engage in a discussion, a conversation as to why your policies and procedures are on par with theirs, why they should be able to trust you and what you're doing. Whereas now, we are regulated by the same regulator. We are pari passu. We have the same policies and procedures implemented. We have the same duties that they have. And so they can take comfort knowing they don't have to constantly look over our shoulder and make sure that we're performing up to the level that is required of them, because it's required of us. So we realized we needed to be a bank. Okay, that was clear. But becoming a bank, that was not so easy. It was an intense process. And speaking as someone who has gone through many licensure and regulatory processes, both at a state and federal level, I mean, SEC, CFTC, multiple state regulatory regimes, like, we've done this before. This was by far the most intense process we've undertaken. It took over 3,000 pages of materials submitted, over 35 hours of Zoom interviews, and scores and scores of OCC staffers that we met with and reviewed, and had back and forth reviewing documentation with. So really not for the faint of heart. And one thing I do just want to give a shout out to the OCC staff in this aspect is they were so prepared, and they had such a level of understanding of the technology and the industry going into it. We were very surprised, frankly, because again, we've dealt with all kinds of regulators, and it's really no fault of their own that they should not have a deep understanding of this aspect in this industry. I mean, it's a small percentage of the whole, ecosystem that they have to regulate. So, we've never had a problem helping people get up to speed on the tech, but really with the OCC, we hit the ground running, and the initial questions were like the secondary and tertiary type questions that you would get usually much later in the stage. So that was really a refreshing moment for us. So in this process, as I mentioned, it was very intense, but we were able to succeed. We became a bank, and along the way, something really cool happened. We learned that there are things that are important for a bank, that are unique to a bank, that actually really help with custodying crypto assets. And, we never could have foreseen this, but it happened. And so some of those things that are required by a bank that are unique to that sort of federal regulation are that you have to have a financial and legal independence of the bank. So the bank is one of many subsidiaries in the corporate family of Anchorage. And in order to operate under, the fiduciary requirements, it must be independent from those other subsidiaries. It must have its own financial independence, its own legal independence. It must have independent members on its board. It also, to the extent it engages in lines of business or procurement of goods or services with its subsidiaries, it has to have an agreement in place that is on market terms, and you have to be able to prove to your regulator that those are on market terms. This is not always easy to do, especially when there's no market, but this is something that we worked through and we overcame, and I think we're really better for it. Another really cool element of federal regulation is this concept of credible challenge. So I mentioned that we have these independent directors, but both independent and our internal directors must be able to credibly challenge management decisions. So that means they have to be fully informed. That means they have to be given opportunities to speak and review. And they are able to really review and question and have feedback and input in a meaningful way into management decisions. There's also a heightened level of consumer protection at this bank, at this federal level. And that involves the application of the Gramm-Leach-Bliley Act and what that means for consumer data and how we can use that, how we can store it, how we have to disclose both the use and storage of that to the client. And then also we have to maintain what's called a fiduciary audit committee. And that audit committee's whole, reason for existing is to ensure that we are performing our fiduciary function to our clients. Banks also have to have this thing called 3 lines of defense. And it's really a great way to structure an organization. The first line is your operations, and that's what's on the front lines day to day. They're helping, assist with client information, onboarding clients, helping, administer transactions. Then we have the compliance team. They sit above and they review and monitor the ops team to make sure that they're doing all of this in order with the policies and procedures that we've set in place. Then above them sits audit. Internal audit develops a system to test and monitor to make sure that the compliance and ops teams are doing everything, again, in the way that we've set forth in our policies and procedures. And the final thing, which I think is really helpful, especially for an industry like ours that's very nascent, is the concept of risk-based capital adequacy. So look, any prudential regulator is going to require capital adequacy of a bank or other type of financial institution. Obviously, we know that just fundamentally makes sense. But how you determine the level of capital, the amount of capital required, can vary wildly by different regulators. Different states have all different methods. Some have just a fixed amount, no matter what the entity or business lines, whatever, it's just arbitrary fixed amount. Some have a scaling amount based on revenue or the amount of assets under custody or under management, and that infinitely scales. What's really cool about the way the OCC, the methodology they use, is it's risk-based. It's specific to the actual organization, the lines of business that they undertake, and the risks that are faced in actually providing those services. Then you do an analysis about the exposure based on those risks and what capital you would then have to cover that exposure. It's really, you can look this up in the Controller's Handbook, but it's just, we think, a very important and specific way to look at this risk and these needs. So with all these heightened standards, with being a bank, here we are, and it's like we almost can't win, because on one hand, you have these people saying, oh my gosh, crypto is the Wild West, we need to regulate it, there's fraud, there's market manipulation. Then on the other hand, you have people saying, well, the OCC shouldn't be regulating crypto, that's not within its mandate. And it's just, you can't win. We think that regulation is extremely important for this industry. Without regulation, we will never have mass adoption. Institutions aren't going to want to get into the space. Obviously, you need to have a safe and sound ecosystem to operate in. But we do find the irony where we have, a lot of people out there saying that we shouldn't be regulated, because I don't really know what the alternative is. But on that note, what does all this mean? What are we here for? What is the future? We're pretty excited about it, but what we're doing this for, first and foremost, is mass adoption of cryptocurrency. We think that it's great that we have, a lot of wonderful people in the crypto industry that are involved, but we want to get this into the hands of Main Street. We want everyone to be able to access this asset class, even if just a tiny, tiny portion of, their allocated capital. We think inclusion, again, is really important. And it's absurd that in this, day and age, we still have a significant portion of the US population as or underbanked. And we see blockchain and this technology as a way to improve that. Importantly, this is not a death match. I don't know why we have been pitted so strongly against traditional banking institutions, because we are not in some like fight to the death sort of challenge here. We think that a symbiotic relationship is what is required, frankly. And we love working with banks. We see banks as partners. We would love to help all of the big financial institutions bring this asset class to their investors. And we can do that on a sub-custodial level where, you know, they can maintain the client relationship and we provide that technology. But obviously under the, you know, oversight of the OCC. And, you know, all this being said, I don't know anything, right? The only thing I do know is that surprises are going to happen. We don't know what's around the corner. We're optimistic, but we just, you know, we're not certain. And the best thing a regulator can do in this position is to provide thoughtful regulation that helps the industry, that protects investors, and doesn't stifle something before we have the opportunity to see all of the wonderful things that it can accomplish. So on that note, thank you again for joining me, and I hope you enjoy the rest of the conference.